us, and still a number of questions are coming about Europe's crisis and the steps to be taken in order to tackle the crisis. The breaking news are coming from Spain, where the new elected government is now facing the quick action in order to shore up investors' confidence. And actually, this is the fifth. This is the socialist, the fifth government in Europe, the socialist government in Spain to face now the debt crisis. In Greece, whose financial woes touched off the market nervousness now felt around the world, more political wrangling cast pall over the new technocrat prime minister as bid to win the nod from European leaders on Monday for bailout funds. Borrowing costs for both Spain and Italy hit unsustainable levels last week before the European Central Bank stepped in to stabilize the market. Last Friday, the euro was a bit higher, but European shares hit new 5-week lows and fears it was a short-term fix. The Spanish people look to set to give the center-right party an absolute majority in the parliament and a clear mandate for more austerity against the background of soaring unemployment and one of the highest budgetary shortfalls in the region. So as we can see, basically the crisis, as expected, is spreading from Greece, Italy. Now it's hitting the third big economy in the Eurozone, which is Spain. Now it's up to the newly elected governments, with the only one elected actually in Spain. The other two are non-elected technocrat people to act quickly and handle the current problems. However, the markets are still in the rather neutral mode in past couple of days, awaiting more clarity on how the Eurozone crisis will be handled, and the victory for the Spain's center-right spurs some hope of reform, but the situation remains still fragile, while also the U.S. Congressional Committee looks set to miss deficit reduction deadline. As immediate reaction, the risk aversion pushes the Aussie dollar against US dollar to its 6-week low. Also mentioning United States, the deficit cutting process seems to be again in the dead end, as Washington's most ambitious effort in years to come actually to grip its mounting debt is set to end without any firm results. Actually, it's due today, as negotiators plan to announce they have failed to reach a deal. The Republican and Democratic leaders of 12-member congressional super committee, so-called super committee, are set to declare defeat in joint statement to be released after 3 months of talks failed to bridge deep divides over taxes and spending. After a year of losing budget battles, it's another sign that U.S. lawmakers are too entrenched to compromise on the tax increases and benefit cuts that budget experts say are needed to set the country finances on the stable path. Also, the global economic outlook, according to Chinese, remains grim, as Chinese Vice Premier Wang Qishan warned on Monday that the global economy is in grim state and that an unbalanced recovery might be best option. At this had this at talks where senior U.S. officials said the mood at home towards China was souring. The remark marked Wang's second dire comment on the world economy in just a few days. On Saturday, he said the chronic global recession was certain and China must focus on its domestic problems. Policymakers globally have expressed increasing alarm at the risks facing the world economy, mainly stemming from a financial contagion in Europe. Today, the Singapore and the Thailand forecast their economies would shrink in the fourth quarter, and Japan posted a much bigger fall in October exports than expected. So basically, the current outlook's not promising at all. What I wanted to mention also, there was an interesting article in the Saturday's issue of Wall Street Journal, wrote by Niall Ferguson, who makes a comment about Europe in 2021 year, 10 years after the great crisis of 2010 and 2011, which claimed the scalps of no fewer than 10 governments, including Spain and France. Some things have stayed, but a lot has changed. He sees that euro in 2021 is still circulating, though banknotes are now seldom seen. Indeed, the ease of electronic payments now makes people wonder why creating a single European currency even seemed worth it. But Brussels has been abandoned as Europe's political headquarters, and Vienna has been a great success. In his comments, he says there's something about the Habsburg legacy, explaining the dynamic new Austrian Chancellor Marshal Radetzky, and it seems to make multinational politics so much more fun. The Germans also like the new arrangements. For some reason, we never felt very welcome in Belgium, because German Chancellor life is still far from easy in the peripheral states of United States of Europe, as he calls the new political arrangement in the Europe in 2021. Unemployment in Greece, Italy, Portugal, and Spain has soared to 20%, but the creation of new system of fiscal federalism in 2012 has ensured a steady stream of funds from the North European core. So this is the view of the writer of possible political and economical arrangements in a period of 10 years ahead of us. You can find this article in the Wall Street Journal if you would like to read. Now back to our work. Very thin calendar today, as Japanese guidance released already earlier showed a further extension to 0.46 trillion yen compared to the 0.1 trillion previous month release, and 0.20 trillion forecast for today. So the all instability monthly release showed a negative drop to by minus 0.9% as forecasted, versus the minus 0.3% the previous month release. The current account of Europe is due at 9 o'clock GMT, and the forecast of today is showing some narrowing to minus 3.2 billion euros versus the previous month gap of minus 5 billion euros. From Canada, wholesale sales monthly are due at 13.30, and the expected raise for today is 0.6% versus previous month release at 0.2%. And the latest one for today, U.S. existing home sales due at 1500 GMT, slightly lower than previous month, 4.91 million. New home sales is expected at 4.82 million new homes for the past month. Let's now take a look on the technical part and see what were the developments in the markets. As well, the euro is still within consolidative range, but losing strength and losing momentum in the early hours of European session. The latest price action shows the pair dropping below 135, where it mainly hovered during the end of Fridays and the beginning of the Asian session. Actually, during the whole Asian session, the pair remained within a narrow range around the 135 level after Friday's strong rally through initial barriers at 135 and 135.50, stalled on approach to 130, actually stalled on just above 136 barrier, and just under the main bear trendline resistance at 136.32. The hourly outlook is weakening again now as MACD is breaking below the midline, and momentum is well below. The 20 days hourly moving average is currently maintaining the recent fall at 135.21 standing currently. Immediate focus comes on the support at 134.50 and then 134.21 previous lows, as well as strong 134 zone support where we have the weekly Ichimoku cloud base that already contained one dip lower at 134.07. It's a significant point that the price during this year has never been below the Ichimoku cloud, being contained. Even the previous dip to 131.45 was contained within the cloud. That might keep some support for the pair at this stage. On the 4-hour, the structure is weakening again as the upside remains firmly capped by a main bearish trend line drawn from 142.46 high, currently standing at 135.95, and then we have 136.14 level that is currently maintaining the negative tone. Daily outlook remains firmly bearish. Both studies are below their midlines, and the price action moving far below the moving averages, with the immediate 155 days moving average currently at 137, capping the upside attempts and maintaining the negative action for the euro dollar. The British pound is a similar situation as the recovery attempt from 156.90 17th of November low. Failed on approach to 159 level, also 50% Fibonacci retracement of the down move from 160.88 down to 156.90, completing actually the hourly head and shoulders pattern on break of neckline at 157.40 zone, and now traveling south with immediate target at 157.17 and then 157, 156.90, which is the low of 17th of November, so last Thursday's low. And the expectations are, as the studies are weakening on hourly and remaining weak on the 4-hour charts, for further extension lower. We can see it on daily that the next level comes at 156.30, which is the low of 18th of October, ahead of 56.18, the 61.8% Fibonacci retracement of the 152.71 to 160.164 ascent. And actually, this is the last barrier before the possible fall and extension down towards 152.71. Daily studies are also weakening at this point as the MACD breaks below the center line, and 55 days moving average currently at 157.88, capping the upside. Dollar yen is maintaining a slightly negative tone as shown the 4-hour chart, as the 20 days moving average keeps capping the upside after a post-intervention rally peaked at 79.52 and immediate pullback dip down to 77.75, which was our initial support. Loss of this level gradually extended the losses to initially 76.80 and then 76.56, which was the low of last Friday. The current recovery attempt bounced from 76.55, found a strong barrier at 77, which is along with 77.15 level, capping the upside for now, and subsequent fall is keeping the price now below 76.80, which was our initial previous support. The hourly studies are in the negative field as well as 4-hour, and the downside remains favored. For now, loss of 76.52, open 76.30, and then 76.10.00 zone. On the daily chart, the loss of momentum triggering also break attempt of MACD to break below the midline in order to extend further down, as 55 days moving average currently at close to 77 zone, which is another upside barrier, is capping the upside action for now. The broader picture remains firmly capped by 200 days moving average currently at 79.55, which is also close to previous post-intervention high at 79.52. Only break here would improve the current outlook for dollar yen. Dollar Swiss, it seems it's regaining strength after being entrenched in the short term within the range of 91.40 and 92.34 after hitting the fresh 92.34 with the last Friday's dip under 91.40 zone, 900, finding good support at 90.80. It is also the previous high of 90.81 posted on 20th of October. Holding above here keeps the immediate focus higher as the pair regain the levels above 91.40, 91.50, returning back to this and currently attempting at 92 barrier in order to refocus 92.34, a high of 17th of November, a break of which would extend the uptrend which remains firmly intact for now. Towards 93.13, the high of 6th of October, and then we have the Forex, 93.38, the March, 27th of March high, which are our initial targets. So here break above 92.34 is to open 93.13, 93.38, initial targets of dollar Swiss, and as well as ending signaling an end of the current corrective pullback that was basically contained by bull trend line drawn from 70.67 low, historical low of dollar Swiss. The gold remains for now steady, but the focus still at the downside as the hourly studies maintain the rather negative outlook. The recent low at 17.10 that contained the latest losses is now vulnerable again as the price action moved just above this level, and this brings actually the 1700, the previous strong resistance, now support in focus. Also, this is the close to 38.2% Fibonacci retracement of the broader uptrend from 1532 up to 1802, and break here to signal further correction of this move. As we can see on the daily, the price action remains below the 55 and 90 days moving average. That puts additional pressure. However, the studies are still in the positive field, and the regain of minimum 1750 is required to turn the focus higher for possible attack, renewed attack at 1800. For now, the focus remains at 1700, the key support zone, below which would be further bear action, and open 1680 and then 1667, which is 50% Fibonacci resistance. Crude oil is at the back foot after a strong rally from 98 zone, surged through our initial and strong barriers at 100, 160 to test the next level at 103.36 with 103.35 seen ahead of a strong reversal. The pair is currently in the third way of reversal from 103.35, as we can see, 1, 2, 3, and a further extension down towards 97.20.30, which was the actually this has been taken, pardon, 94.50 zone is would be our next target. Actually, this is the break point. So we have the low of 9th of November and the high of 25th of October, and this would be key for a further extension lower of the crude oil price. Or the broader picture, the current reversal is just taking out the initial 23.6 Fibonacci retracement, and coming to 200 days simple moving average currently stands at 95.51, loss of which would trigger further weakness of the pair, and focus the levels as mentioned earlier. 94.50 is the next strong support ahead of 92.55, which marks 38.2 Fibonacci retracement of the broader uptrend from 70.44 up to 103.35.